Hey, good morning, options traders, and I hope everybody had a fabulous long weekend from the 4th of July. And I got a request from one of our traders asking to maybe do a series on risk management. And I thought, what a great idea, because after all, you as a trader are ultimately a risk manager. And one of the reasons that we love options so much is that they give us the ability to manage risk better than any other tool on the planet. But the question that most people have when they're trading options is that they think that it begins with theta, and that you always have to manage theta and be aware of theta or sell options to offset your theta. But risk management actually begins with delta. So let's find out why. So recall, as a quick refresher of your Greeks, at least for the basic ones, there are others, but we have delta, gamma, theta, vega, and rho. And so again, of all of these, delta should come first. This is what you have to be aware of the most and make sure you are managing. And I'm not saying that the others aren't important, but delta should come first. And the reason is that if we look at what delta is, it should be very obvious. So recall that delta is the slope of the risk profile. So here we're looking at shares of stock, and it always sits on a 45-degree line. That's just dollar for dollar up and dollar for dollar down. And this is what creates the biggest risk. If you ever have a trade that goes against you in a really big way, it is because of delta. It's because the stock just made a really big move or a fairly fast, aggressive move and puts the option out of the money, or maybe it's a short option and it goes super deep in the money, but it's always delta. It's very rarely any of the others that cause the biggest risk. So it's the slope of this line that we have to watch, and we can control it very easily with options. So if you have no shares of stock, this is what it looks like. It's flat. You have no response to changes in the stock's price. But let's say if you bought 10 shares, now your slope starts to get a little bit of an angle to it. You can make some money if the stock price rises, but you're starting to lose if it falls. If you buy 20 shares, get a little bit more peaked. 30, 40, 50, 60, 70, 80, 90, and then finally here are the 100 shares. So you can see very clearly that the more deltas you put into a position, yes, the more you can make if it goes in your favor, but the more you can lose if it goes against you. And so as options traders, what you don't want to do is just focus on this end of the graph and say, look at everything that I can make. Look at all of these deltas up here. You have to focus down here first. What are the potential losses? And it's the delta losses that are going to create the biggest in most cases. Now, what about gamma? A lot of traders say that gamma is the biggest risk, and on one hand, we could make an argument for that. Gamma is the curvature. So here is a straddle, that's buying the 100 call and the 100 put. Got our bend right there at 100. So these positive deltas in blue are coming from the long call. The negative deltas over on this side are coming from the put. So this is what it looks like at expiration in blue, but today we look like this one in red. And you see how it's curved? There's a lot of curvature and therefore a lot of gamma in a straddle. And because risk is sometimes defined as the uncertainty of the change in prices or the whipsawing of prices, sure, you could make an argument that gamma is a big risk. But if you think about it, gamma shows the rate of change of your deltas. It's ultimately just a delta risk in disguise. So yes, if you start here in the center, you might have fairly low deltas, almost zero. But if the stock price rises out this way, look at that. You start manufacturing positive deltas. And that's a good thing. But if you start here in the center and the stock price falls far enough, you start generating negative deltas, which is also a good thing. The problem with this much gamma is that you have a very wide break-even point. So even though you could make an argument that you're getting the benefit of positive and negative deltas, the straddle is really more of a gamma play. But the thing again that it's doing is it's just generating deltas. And so that's why I wouldn't put it as the first risk. Gamma is usually not what's going to hurt you. Now, what about theta? Theta, of course, is our time decay. This is the one that everybody thinks is the big risk. I would be willing to bet if you asked 100 options traders, virtually everybody would say that it's theta. But think about it. Theta measures the effective time on your option. How much does your option lose per day or per unit of time? But time moves in one direction at the same speed. In 30 days, it's not a surprise to anybody that 30 days have passed. And so if you buy an at-the-money $100 call for 5, let's say it's a 1-month option, the very moment you buy this option, you know for an absolute fact that this $5 worth of extrinsic value will be 0 at expiration. So why is that a risk? Not only is it 100% known that it will lose, but we know by exactly how much and when. It's not really a risk. It's instead what professional traders refer to as a characteristic of an option. It's part of its behavior, but you shouldn't really consider it a risk. Risk always has to do with uncertainty. And as I just showed, this is absolutely one of the most certain things that you'll face with options trading. So even though theta is something that we have to understand, and in some cases might need to manage or offset, you shouldn't consider it your first priority. Now, Vega, of course, stands for volatility, for those of you who have had the Greeks. And what it does is it shows the sensitivity of an option's price in relation to volatility. So if volatility goes from 20% to 21%, that's a 1-tick change in volatility. How did that affect your option's price? How much did it gain or lose? That's Vega. And while Vega can certainly be a risk, especially normalized Vega for any of you who might be selling naked options, the problem with Vega is that in most cases it's usually slow to change, especially in the short run. And it's also mean reverting. So if you know that the current volatility is 20%, that is absolutely your best guess over the next 30 days. There's not a lot of uncertainty. And again, it's mean reverting. So if you do happen to get caught in a spike that goes against you, if it's a longer dated option, you can ride it out. And in most cases, it will fall right back out of the option. So for instance, here is a chart of the VIX, the Volatility Index, from 1990 through mid-2021, all the way out here on the right. And you can see that overall, it just goes sideways. Sure, you can get some big spikes. Here's 08-09 financial crisis. Here is coronavirus, both of them peaking up over 80. I think we got to 85 here during coronavirus. And you can see a handful of times we did break 40. But look at how quickly, in all of those cases, it falls right back down to the long-term average, which is roughly 20. It's about 19.5 over this time period. So again, if you happen to get caught in one of these spikes, it's most likely going to revert back to the mean in a short time. So even though Vega can certainly be a risk, I certainly wouldn't put it as your priority. That would not be my first thing to watch. So for instance, let's take a look at a vertical spread. Let's say that you want to buy 10 100-105 verticals for $2. Well, that's a total cost of $2,000 and a max gain of $3,000. And too many times people look at this and say, all right, I can sustain a $2,000 loss and I would love to make the $3,000. Let me put this on. But take a look at your deltas. Here's 100 shares of stock in red. Here are your 10 contracts in blue. So yes, look at how much steeper this is right here in blue. And that can be a great thing. Look at how quickly it propels you into high gains just from the stock going from 100 to 105. Puts you right at max gain of 3,000. Whereas if you had 100 shares of stock at 100, you would need that stock to go to 130. See, that's where the red and the blue line cross in order to get the same 30 points. But look at what happens. Let's say the stock is maybe at 106, getting close to expiration, and now it goes against you. Look at the size of that fall. You're going straight off a cliff, and you need to be aware of that. Now, of course, this is the expiration graph, but prior to expiration, you're going to look something like this. And this green line will start to move down over on the left side. You've got negative theta out here. It will begin to rise over here if the stock is at your short strike or higher. But even look at how fairly peaked that green line is, and it's only going to get steeper. And you need to be aware of that. And yes, you've got positive gamma on the left. I can see that. You've got negative gamma on the right. But those are not really my big concerns. It's how are my deltas changing and what will they be as we get closer to expiration. Because if you're not aware of that, you're going to work really hard to watch this stock rise from 100 to 105, or maybe even from 95 to 105, and find that with only a $2 or $3 move, that all of those profits are virtually lost. And that's because you weren't focused on delta. And so, for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.